Welcome, everyone, to today's webinar on the World Energy Investment Report that was released just 2 weeks ago. My name is Cecilia Tam. I head up the Energy Investment Unit at the IEA. I'm pleased to be joined today by some of our lead authors of the report, Kirsten Smith, Hanul Kim, James Bragg, Courtney Tuck, and Rio Yamasaki, who will share with us the key findings from the report. Before passing on to my colleagues, I'd like to go into the details of the report. I'd like to kick off the webinar with an overview of the objectives of the World Energy Investment Report. First launched in 2015, the World Energy Investment Report tracks capital flows into the energy sector across different sectors, fuels, and technologies. It also provides the IEA's first view on spending for the current year, and for 2026, we anticipate that total investments into the energy sector will reach $3.4 trillion. This figure shows how that spending has changed over the last decade, with renewables, followed by grids today, accounting for the largest share of investments compared to oil and gas in 2015. What and how much the world invests in today are leading indicators of where the energy system is heading. This year, as we began to collect the latest data on investments, with the Middle East conflict breaking out in February, it was clear how the world responds to this crisis will have major implications for investments. With that introduction, I'd now like to pass it over to Kirsten Smith to tell us more But before giving her the floor, I'd like to invite all participants to submit any questions to us via the Zoom Q&A function. And after the presentation, we will have 30 minutes to answer questions that you submit. Kirsten?
Thank you, Cecilia. When we were looking back at what the potential implications from previous energy crises were, we looked at the change in investment in various energy technologies since 2021, comparing them for net importers and exporters. When we look at what was invested in, across the board, we saw increased investment in renewables, grids and storage, and electrification and efficiency, as well as in parts of the world, we saw increased investment for net energy importers for coal. When we looked at energy exporters, they saw record revenues, but some of that went back into oil and gas, but with a little bit of less of a focus on diversifying some of the rest of the energy mix. The Middle East conflict is likely to result in some of the same levers being pulled today, providing a powerful accelerant to changes that are already underway. With that, I would like to pass the floor to Courtney to talk about supply.
Great. Thank you, Cecilia and Kirsten, and everyone who is here. The supply chapter of the World Energy Investment covers oil and natural gas, coal. We also look at bioenergy fuels. We look at CCUS. We look at critical minerals, and there are many authors of this report who I share this work with. And so I want to acknowledge them and to please invite you to go look at that at the full chapter. Here we're only going to talk about two aspects which we think are most revealing. We want to talk about upstream oil investment, and then I'm going to talk about coal supply investment, both of which are very interesting this year. Obviously, when we think about oil, we think about the Middle East, and when we think about the Middle East, we think about oil. With the ongoing conflict, which we take a moment to pause and consider the human dimension of, we also need to understand the strategic position of the Middle East and its oil investment over time and this year especially. So here we look at this in terms of the cumulative investment. This is from 2021 to 2026 in upstream oil. North America clearly outspending all the other geographies, almost double or more than double what the Middle East has cumulatively spent over that time period. This is just over the last 5 years. But then let's look at what that actually produces in terms of cumulative resource developed. Here, that small dot over on the right over Europe represents is our scale, representing 5 billion barrels of oil developed. That is what oil, that is what Europe represents. But then we go back over and look at what's happening in the Middle East and North America. Despite that outsized investment in North America, which of course has been largely driven by tight oil developments in the continental US, as well as a few other strategic areas in US federal offshore or Alaska, we see that the Middle East is actually developing more oil than North America for the same amount, or for much, much less investment. So these are some of the lowest cost barrels on the market. This has huge implications for the development of resource. It also has a certain quality of oil, which is very important to the global mix. But what's very important in the current conflict is to know that about 65% of that oil would be normally flowing through the Strait of Hormuz, and has obviously been highly curtailed. And so what we did in looking at investment in 2026, although a lot of reporting suggests that investment should continue, there's a lot of inertia in the oil investment system. However, we did see a revision down for investment specifically in the Middle East. There are sort of three main reasons for this. One, in some geographies, especially like Kuwait and Iraq, which are really curtailed by the Strait of Hormuz, who do not have pipeline access, their production is down, their revenues are down, and so it's just hard to have the capital available to spend. There are daily new reports of these companies and operators and governments trying to build new pipelines, and so that's something we'll be following very closely for the 2027 edition. The second reason is that there are security risks and premia, and so getting flows moving again once the straits open will also attract greater expenses and need to be carefully considered. And then the third reason are the repairs that are going to be needed for infrastructure, for pipelines, and even for some upstream fields. So that is our story for upstream investment in oil. And now I just want to say a few words about coal. Coal supply investment now stands at its highest level since 2012. You can please go read the medium-term coal report from 2012 to understand some of the drivers of that. Obviously, a lot of it is demand. This is coming mostly from China. You can see China far outstripping the absolute investment of every other geography. But then if we look on the right-hand side, this is taking China out of the story, and you can start to see some additional investment climbing in India. This is mostly to try to curb some of the imports. You see Russia starting to, not this year, but Russia is having some activity around having additional export capacity. And then the investment growth in China is really a story of sustaining capital expenditures and upgrades. We're also keeping an eye on coal to chemicals investment because that, of course, reduces your need for oil-based petrochemicals. So now we will hear about how some of that coal and other things are used from James.
Thank you so much, Courtney. So I'm going to spend the next few minutes talking about some of the key trends in this year's edition for the power sector. So I'm going to begin with investment into low emissions generation, which includes renewables and nuclear. And really, over the past few years, in particular between 2022 and 2024, the picture was characterized by explosive growth in renewables investment. And you can see here that for a large part, this was driven by growth in China. However, moving into 2025 and now going into 2026, we're seeing that this trend has actually come into reverse, and investment in China has actually begun to decline. So there's a couple of reasons for this. The first is the most obvious and the most important, which is simply that the costs of solar and wind continue to decline globally, but in particular in China. And so this has really compressed the capital cost per unit of capacity delivered for renewables. But the second factor is the result of, or is regulatory changes which took effect at the midpoint of 2025. And our prediction at that time was it would create additional revenue uncertainty for project developers and eventually lead to a cooling down of that project pipeline for renewables. And indeed, over the second half of 2025, and in particular in the first months of this year, we have seen capacity additions come down quite significantly. United States renewables investment is expected to come down as well too, but here this is primarily due to regulatory uncertainty. And of course, the phasing out of some of these fiscal incentives for renewable projects. Now, moving on to fossil power, here we're seeing something quite remarkable emerge in the data. In recent editions, we've been keen to highlight the rise in spending on coal generation in China. But in 2025, and we're expecting this to continue to 2026, we're seeing United States fossil power spending, especially on gas, rising very, very rapidly. So much so that for the first time in over 2 decades, we're expecting the United States' investment in fossil power to actually surpass China, making it the world's largest investor in fossil power. And then the final dimension I wanted to highlight on this slide is grids and battery storage. So in recent years, we have been trying to bring attention to the growing disconnect in investment between generation on the one hand and grids on the other. But what we've seen now in 2025, and again, we're expecting this to continue into 2026, is double-digit growth in grids investment, which is really an encouraging sign. And this is cemented also by increased investment on battery storage, which we're expecting to increase to surpass 100 billion in 2026. The one caveat to this encouraging story, though, is that we cannot confidently attribute all of the increase in grid spending to more infrastructure being delivered. And that's simply because there's still a lot of supply chain tightness, and we're still seeing rising costs for key equipment such as transformers and cables. Now, for the last slide before I hand off to my colleague Hanul, I want to come back quickly to the remarkable rise in gas-fired generation that we're seeing in the United States. And so in our report, we typically focus on annual investment spending, but we also track final investment decisions for FIDs. And that's the moment when project sponsors decide to commit capital to a project. So decisions to move ahead with new gas-fired power plants have risen sharply since the start of 2025. What you're looking at here on the slide is the value of those FIDs from Q1 2025 to Q1 2026. But that was really driven by one country, and that is the United States. And so, of course, this is a complex issue. There's many reasons for this. But of course, a key one is demand from data centers. That applies to grid-connected projects, but also new turbine orders for on-site gas generation. So since the beginning of 2025, about $28 billion of new gas turbine orders were destined for on-site power generation at data center sites. And indeed, in Q1 of this year, we actually saw orders for on-site data center generation surpass orders for grid-connected generation for gas. So that's really quite a staggering finding. And it very much reflects this growing premium for speed to power, which better reflects the faster build times of data centers. And then zooming out, if we look at total energy sector investments for the build of data centers globally in 2025, that's now over $100 billion. And so to put that into context, there's actually more than what is being invested in all of Africa's energy sector. So this is really a key story. And I'm going to hand over to my colleague, Hanul.
Thanks, James. Now we're going to look at end use. So from the past two speakers, we listened to how supply of energy works, about how fuel is being supplied, how electricity is generated. Now we look at end use, which is the other half of the story, focusing on how this energy is actually being used. And at the IEA, when we look at end use investments, we track 3 sectors mainly: buildings, transport, and industry. And I would like to walk you through some of the main findings we see here. So to start with what we are seeing overall in the 3 sectors and also how investment is happening, the first thing to note is that when we look at end-use investments, we track the additional amount of spending that is required to have a more efficient level of technology compared to our conventional alternative. We also looked at electrification, which is not just about using less energy, but about shifting the demand of energy services towards electricity, which can divert the focus from using direct fossil fuels in the end-use sectors. So if we look at the three sectors, first of all, you can see that it is growing across buildings, transport, and industry. And in 2020 and also in the recent years, buildings has been the largest factor in when you look at the end-use investment. However, this composition has been changing in the recent 2 years, with transport spending really surpassing the amount of investment in the entire end-use landscape. And the reason for this is because weaker developments in the building sector, especially in energy efficiency, due to the issues in the construction sector, weakening activity, and also this has a very strong link to the decreased direct funding and public support that is being provided for retrofit programs and policy uncertainty as well. And this is especially important for the building sector in particular, since this can be the lack of public support means that this can be a hindrance to the very big consumers that have to make investments for into a very large upfront cost investments when it comes to retrofitting or making renovations to their households. In the case of EVs, this is really contributing to the growth of electrification that is happening in the end-use sector. So from about like 40% in 2020, you can see that electrification is taking about 50% of the total end-use investment right now. And this is really very much due to the increased electrification in the transport sector, which is led by EV adoption, not only in the major economies that we saw, such as the United States or China, but also we're seeing evidence of electrification in transport growing in EMD other than China as well. And this is due to the lower cost of electric vehicles, as well as policy incentives and stable policy signs that is really increasing support for this sector. Also, electrification is led by heat pumps and other electric technologies across the board, which is really which is showing how much our economy and is also how energy demanding is shifting towards this new age of electricity. But the story of end use doesn't start or end when we look at just clean energy consumption, but it really has another dimension to it, which is especially timely right now. And energy efficiency and electrification investment actually contribute a lot to resilience of energy systems. So if you take a look at the countries below, you can see that these countries on the screen are one of the most are net importers of energy, of fossil fuels. And if you take a look, they have invested around 20 to 40% of their entire energy investment into end-use electrification and increasing efficiency. And if you look at how much they have invested in the past decade, from 2015 and 2024, they have rendered these effects of actually delivering in savings when it comes to fossil fuel imports. So if you look at the red in the screen, you can see that this has rendered around 30 to 40% of the amount of investments that they actually put into end use that have resulted in less imports when it comes to fossil fuels. And also in the case of Southeast Asia, which is a net exporter of natural gas and coal, this has also not only has it first reduced imports in oil, but also due to increased export revenues in natural gas and coal and oil, coal. You can see here that it has actually resulted in spending in savings more exceeding the actual annual amount of investment that is put in. So the story of end-use investment is not just about decreasing consumption or having more cleaner energy systems, but it also has an element of having more resilient energy systems as well. And this is why end-use investment has really rendered important messages and savings in a time of external shocks, and also in times where energy systems really rely on resilience. And with that, I would like to pass on to my colleague Rio to cover the finance chapter.
Thank you very much. So next, let's focus on broader financing trend and how energy investment are financed. A key finding in our analysis is the deep divide between advanced economies and emerging markets. The chart on the left breaks down regional energy investment in 2025. It shows exactly who is investing and where the money comes from. Advanced economies account for over 40% of global energy spending, and as you can see, 5 actors drive this spending. In fact, 3/4 of these investments come from private companies, and 80% are commercially financed. This is very different from emerging market where state-owned enterprises play a massive role. Today, the main driver are the strongest sectors within these strong countries, namely big tech industries, advanced manufacturing, and so on. So they have the earning power, strong credit, and future growth potential needed to continuously attract private capital. So by tapping into deep capital markets and bank loans, they are strongly leading the age of electricity. And you can see this strong momentum in the project finance data on the right. So bank-led project finance has grown steadily since 2022. In 2025, it reached nearly 500 billion, and over 70% of these deals took place in advanced economies. Last year, funding for low-emission power like renewables continued to rise. At the same time, we saw a market-driven boom in US natural gas financing to support the massive power need of data centers. So in short, leading companies in advanced economies are successfully using private capital to push energy investment forward. And let's look at emerging market and developing economies outside China. So here, the finance environment is completely different. These regions hold 2/3 of the world's population, yet they account for less than 30% of global energy investment. The chart on the left shows exactly why they are struggling by looking at the cost of capital. In these countries, the cost of capital reflects both broad economic conditions and specific countries' project risk. Over the past 5 years, many factors have pushed this cost much higher. So we have seen inflation, rising interest rates, currency shift, and the energy crisis. So because of this, their cost of capital remain much higher than in advanced economies. And recently, technology prices have dropped. For example, solar panels are much cheaper now. However, this is definitely good news, but data from the IEA's cost of capital observatory shows that even for these technologies, the cost of capital in 2025 is still higher than it was in 2019. And global shocks do not impact all regions equally, and the negative effect of the energy crisis and geopolitical risks have hit emerging countries particularly hard. So there's a growing concern over how the current crisis in the Middle East will hurt investment this year and beyond in those regions. And this worsened investment climate is a huge problem because these regions desperately need more finance. Look at the chart on the right. Under the steps stated policy scenario from World Energy Outlook 2025, we see a massive need for financing. So by 2035, financing in emerging market need to grow dramatically, over 20% increase compared with 2025, to meet rising demand and ensure energy security. Right now, state-owned companies are driving the important role in this investment. But to reach this massive scale, we need a huge increase in private sector funding. And how do we mobilize those private fundings? In addition to standard finance discussion, we now need to put into practice the tool we have been prepared and discussing the last 5 years. So this means actively utilizing transition finance, coordinated international public funds, and blend finance as well. So using these mechanisms is essential to lower risks and unlock the private investment this country needs. I'll stop here and over to you, Kristen.
Thank you, Rio. Just before I jump into research and development, I wanted to remind our participants that they can ask questions through the Q&A function of the Zoom webinar. So when we think about research and development in terms of our overall energy investment spending in that $3.4 trillion spent in 2026, our research and development investment numbers are actually outside of that 3.4 trillion, but they're an important component of the energy system. We think about how it changes over time. After the oil shocks in the 70s, this was a massive upswing period for energy investment into energy R&D as countries were looking for alternative ways to meet their energy needs. This period really accelerated the amount of capital and the development and scale up of many of the energy technologies that we currently use today. Today's energy shock could produce a whole new round of energy innovation with perhaps a role for shortening some of the innovation cycles with AI. But there's both a lot of collaboration in research and development as well as competition for technology leadership. So if we look at public R&D spending on energy in particular in 2015, three regions, China, the European Union, and the United States, were quite even in the amount they were investing in this area. But in 2025, China's really taken the lead here, followed closely by the European Union. So we're seeing some different strategies around how countries are choosing to support the R&D ecosystem. Alternatively, if we take a look at the venture capital investment in energy, again, the three markets of these same regions were quite close in 2015, with the United States slightly ahead. But in 2025, the United States really has taken the lead in the venture capital market. And this is really because the United States has a strong private investor appetite for taking on innovation risks. So when we think about the role of energy research and development, and especially in the current crisis, we could really see R&D accelerate some of the previous trends that we've been seeing for years as countries are really looking to build their energy security profiles, build more resilience into their system, as well as just continue to electrify and pursue policies that they had previously been pursuing. But whatever way you look at it, the central message of this report is really the Middle East conflict will leave a lasting impact on the future of energy investment in the energy sector. And with that, I will pause for a few minutes and hand it back to Cecilia for our Q&A.
Thank you very much. So please send us your questions via the Q&A function on the Zoom. We're going to take a 2-minute pause to collect up the questions, and then I'm going to be turning to my colleagues to answer these questions that you submitted. Thank you. Thank you very much for sending in your questions. First question goes to Courtney. How is Venezuelan supply expected to change over the year and moving forward?
That is an excellent question, and one that we are very much in a wait-and-see approach to. There's activity. You see oil and gas company majors are present. They are working with the country. There is a new petroleum hydrocarbon law on the books, and so there are a number of activities that need to sort of unroll in order for that investment to come back firmly into Venezuela. So it is something we're paying attention to. Our understanding is there are some basic payments which need to be made to companies which left previously, and then need to come back in under a secure situation. So something we're paying a lot of attention to. Their supply was down to 0.7 most recently in the most recent years, 0.7 million barrels per day. That is quite a curtailment from previous levels, and so we will be watching that.
Thank you very much, Courtney. Let's go to power now. James, we've got a question about U.S. data centers are investing heavily in off-grid natural gas generation, but is the share of natural gas in the overall data center power mix increasing, or are other electricity sources increasing at a similar pace?
Yeah, that's quite a good question. I think it's difficult to say for sure, but if you look towards 2026 and 2027, there's still quite a healthy expected pipeline of solar PV and wind to come online. After that point is a little bit more uncertain given the regulatory uncertainty I highlighted before. But I think one thing we need to recognize is that these data centers are typically very spatially concentrated. So we think of states like Virginia and Texas, where rapid data center build-out is creating some issues, local issues to do with adequacy and flexibility. And gas power generation has really become the technology of choice in the United States to deal with these issues. So in these contexts or in those particular areas, I think it seems likely that gas generation consumption will increase, especially over the medium term, given the potential downturn in renewables projects. And simply due to the fact that although these DC operators and tech companies are massive purchasers of PPAs from renewable projects, these are always usually virtual. So they're not necessarily actually consuming the electricity that they purchase.
Thank you. Hanu, let's talk a little bit about end-use sectors. The report highlights significant investments in generation, grids, and storage. How does the IEA view investments in demand-side resources, such as efficient appliances, cooling technologies, and electric cooking, as a means of avoiding or deferring future infrastructure investments, particularly for emerging and developing countries?
In fact, all the technologies that you just mentioned is something that we do track in our efficiency numbers. So if you take a look at how much people are investing in more efficient appliances, for instance, is something that we consider in our efficiency investment. As we wrote in our report, it is a way of making the use of energy more efficient, as in this could have an impact on reducing demand in the future of systems, especially when we consider how much electricity demand is increasing in a lot of emerging economies. However, one thing that we would caution is we don't consider investment in supply or infrastructure as an either or with demand. Meaning that demand side investments to make energy systems more efficient has to come side by side with the other grid infrastructure or supply infrastructure, especially since a lot of emerging economies currently need to expand access to electricity or energy in general. So rather than considering this as a way of avoiding or deferring major infrastructure investment, you should consider we should more or less consider it as a way of making each dollar count more efficiently, so that the amount of investment that is needed, or in the long term, the amount of consumption that is needed in energy is ultimately made more efficient or less. So I hope that answers the question.
Thank you very much. In the report, in the finance chapter, there's mention that transition finance is essential for mobilizing funds in emerging economies. The concept is very interesting, but so far, the growth of this tool has been limited. What do you think, Rio, are the specific challenges to scaling it up in these countries?
Thank you very much. I think that is a very fair question. And regarding the transition finance, we released a report titled Scaling Up Transition Finance last October. And in that report, we showed the transition finance can support $4 to $5 trillion of investment over the next decade. And importantly, half of that investment is for emerging countries. So compared to this large potential, the actual use of this tool is still in its early stages. So one reason for this is that there were a lot of debate about the concept itself, and especially regarding regional differences and how to use this tool in that region. However, we recently saw important progresses. So the International Capital Market Association and the Loan Market Association introduced new guidelines about the transition finance. And regional taxonomies in Asia side and the world is now developing. So now the finance need rising, so it is time to create new use case and put this tool into actual practice. And for a more detailed discussion, maybe I will recommend to take a look at the full report about the transition finance report.
Thank you very much. Kristen, in your slides, you showed some trends on public R&D and VC R&D. Could you explain the different roles of these sources of R&D funding?
Yes, absolutely. Sometimes when we talk about the different energy R&D strategies that different actors can employ, people see them as potentially competing for the same projects or different types of technologies to develop. And really, there's a lot of competition in this early technology stage ecosystem, where the role of public R&D dollars through the form of grants or loans to early stage technologies, whether that's in laboratory stage or much earlier stages of development before they can go to the private market for capital. There might be several reasons for that. And then at a certain point, when they get a little bit larger, the technology risk is a little bit better understood. It's time to potentially hand it off to the venture capital market to further develop that capital and find the right partners that can really pilot and then demonstrate that technology at scale. Often, these different actors or investors play complementary roles rather than competing for the same types of projects.
Thank you. I know, to what extent are investments in end-use sectors, particularly efficiency, electrification of transport, heating in buildings and industry, progressing fast enough to reduce fossil fuel demand? Given that the IE indicates that electricity-related spending already represents nearly 60% of global energy investments and are expected to reach about $2 trillion this year. How would you respond to that?
I think the answer would be mixed. So it's really hard to give one definitive answer when it comes to all three end-use sectors. So if you take a look at the investment numbers, you can see that, for instance, transport is growing spectacularly, especially because of increased EV adoption. Also, buildings has been a bit moderate, but has been growing in the past decade. So there has been significant progress in this sector. However, it's really hard to say definitively yes or no, as in is it on pace to replace fossil fuels, because especially if you consider, let's take for example transport, although new car sales are really, EV adoption is really growing in terms of new car sales, there is a very big stock of ICE vehicles that are still running on the roads. There are lots of buildings that are being invested in to become more efficient, but a lot of buildings still are left to be renovated. So if you consider these answers, and if you take a look at the investment needs figure that we actually have in the report, you can see that investments in end use that we would potentially see in our future scenarios, there is a lot of growth, especially that we need to see in the sector of industry that is very dependent on public spending, and also the consideration of cost when it comes to the industry. So it's a mixed answer. It is progressing, but I would say that to definitively say that it is on pace to see the effects of replacing fossil fuels or such, that is still there is a lot of progress that is needed in that sector.
Thank you. Let's go back to power, James. Do you see emerging risks to the global renewable energy build-out resulting from the current geopolitical conditions?
Yes, but I also see a lot of upside. So I think the current disruptions to fossil fuel markets are very likely to lead to a push or an accelerant for the development of domestic resources. And in the context of the power sector, I think that has considerable upside for domestic resources like solar and wind, potentially a longer term role for nuclear as well. There are potentially some risks, or I think that this might spur or sort of an indication of a movement towards more of a low trust world. And so perhaps this sort of shines more of a spotlight on concentrations in clean energy technology supply chains as well too. And as part of this sort of overall story where countries are trying to build up their own energy self-sufficiency. And there's also this risk having to do with potentially higher cost of capital. We know that this is a major challenge in many emerging market and developing economies. Today, we saw inflation data come out of the United States. We also saw Indonesia raise interest rates just this week. And in many of these markets, financing costs are really the key cost driver. It's not the cost of the equipment themselves. So pushing up these costs of financing can lead to higher tariffs, higher strains on public finances, which are already quite strained. So these knock-on impacts of the current energy crisis could have some negative implications for all of the power sector, I would say.
Thanks very much, James. Let's stay a little bit on this thread about the geopolitics and oil and gas company reactions. Courtney, what trends are you seeing on how oil and gas companies are investing in renewable energy?
Yeah, thanks, Cecilia. So we have a bit of this analysis in the report, and that's a really great question, because we did see quite a peak around 2023 of oil and gas majors, especially in Europe, investing in especially bioenergy, which makes some sense. And now we had a trend kind of going down, and now we're evening out at about $24 billion per year on a vast mix of different technologies. We seem to be moving closer into more generation, although there are and overall, though, we see only about 4% of the total capex going to these low emissions investments. But there are some really notable examples where companies are maybe being more directly involved. There's partnerships between Devon Energy and Fervo for geothermal, for example. And we also have the NOCs in China doing some investments in EV battery swapping networks. So a lot of different options that we see, and the sort of curtailments that followed the 2023 peak are now sort of leveling off at around the same level.
Thank you. Rio, the report highlights about progress on clean energy project finance in advanced economies, and that continues to grow. What are the specific sectors that are driving this, and are there any differences between regions?
Yeah, so clean energy project finance in advanced economy is very active, and the report provides a deep dive into this data. So in 2025, major trends in the United States was the strong growth of projects using mature and affordable technologies. So this mainly includes solar PV and onshore wind. And this growth is a clear example of the private sector-led momentum I mentioned earlier. And when we look at the other advanced economies, the focus changed slightly. So in Europe, growth comes not only from these mature technologies, but also from nascent innovative technology fields like CCUS. So for these new technologies, so establishing a clear business model through policy support is essential. So we think this year's success is the direct result of the several years of preparation in those regions.
Thank you. This year's report talked a lot about investments into electrification, but we hear repeatedly about the challenges facing investments into power infrastructure. So Kirsten, can you tell us what needs to be done to really increase and mobilize more capital for power infrastructure investments?
Absolutely. So when you think about large-scale power infrastructure, these projects are massive. They cross great distances, typically transmission and distribution systems. And one of the key investment risks is not in the technology itself. It's a known, proven technology. It's really in the regulatory landscape and how long it might take to actually build some of these projects. So if you're thinking about the role of government policy in setting stable regulatory frameworks, having clear allocations of costs and benefits and to different stakeholders, this is really a key risk that exists for the sponsors and for the financiers of these projects, of them just never getting built because of unclear regulatory guidelines. So I think that the government really has a role here in providing a strong and stable framework for project developers to be able to come in and really understand the risks that they're taking on in pursuing to build some of these projects.
Thanks very much. We've got a question here about critical minerals for you, Courtney. What does the 9% reduction in investments mean for diversification of supply that was in the supply chapter?
Yeah, thanks for that and for the question. Yeah, we did indeed see a 9% drop in investment in critical minerals. This is despite still underlying demand growth that remains very strong, and prices that are recovering from dips in 2025. Supply chain concentration is very high for critical minerals, and it's very high because of sort of a long-term investment strategy by China, especially. They have a long history of investing in their supply chain. There are policies to support that, and they're very buffered from fluctuations in price because they can control sort of the full supply chain of the supply and the refining as well. So there's just a really substantial domestic investments, and so as an incumbent, there's a lot of it's very hard to overcome that, and so basically as other countries and companies try to come in to invest in critical minerals, they're finding very high capital costs for those projects, typically 50% higher than the incumbent producers. And a lot of these minerals also have very high price volatility. So it's hard to start investing when the supply and the experience of China is already so strong. So this kind of diversification of supply, the investment that needs to come probably won't occur just through market forces alone. There really needs to be an ecosystem that allows this diversified supply for critical minerals to evolve and to attract the needed investment to sort of get the ball rolling.
Thank you. We have a question asking about this growing weight of institutional investors in oil and gas major ownership over the past decade. Kristen, can you talk a little bit about what consequences you would draw from this evolution in the energy sector?
Absolutely. So when we highlighted this in the report, one of the interesting findings was that the rise of really passive investment in capital markets has led to an increasing share of institutional investors and asset managers controlling the investments for those retail investors in oil and gas companies. We took a look at the 25 largest energy companies, most of which today are still oil and gas companies, but we're starting to see increasing numbers of electricity companies also being in this top size of energy companies by market capitalization. And really what this means is a lot of these passive investors are willing to provide the capital, and they're not pulling it very easily. They're not more actively engaged in the ongoing management or direction of these companies. They're investing for a stable, sort of broader base market return. And so when these companies are looking at their strategies, there's this huge portion of capital now available to them that wasn't previously potentially just there and available. So I think when you're thinking about it from that sort of perspective of the strategy of some of these companies as they're making future investments, you'll see shifts there. And then from the government perspective, we've also noticed that the share of national ownership of some of the largest oil and gas companies has also declined because of this rise of the retail and passive investor. So I think when you're thinking about crises such as the current one, where energy supply potentially could be at risk, and you need to make sure you have access to energy supply for your constituents, the people that live in your country, there just might be a little bit less of a strategic angle you're able to actively pursue and make sure you can get physical barrels or physical gas to your consumers in your national market with a little bit less of that direct ownership of a company.
Thanks, Kristen. We have a question that I want to turn to both Hanul and James to respond to. If and when the current energy crisis is resolved and we go back to an environment of low fossil fuel prices, do you still see the case for resilient structural acceleration towards electrification and clean energy, especially as governments face growing fiscal and affordability pressures? So maybe turning first to you, James, from the sort of power investment perspective.
Sure. Interesting question. I think we have to recognize as well too that the shift towards clean energy happened many years ago. The business case, the current crisis, is not what had created the business case for clean energy. And they were competitive on their own merits, and they've become increasingly competitive over time. We've been tracking this, how spending has increased, particularly in emerging market and developing economies in recent years. And there really has been a clear shift towards low emissions generation sources. And based off of what we've been hearing in terms of policy announcements, planning documents, that momentum really hasn't changed. If anything, what we've been hearing is that this has sort of created a permanent reputational damage, perhaps, to some fuels, and that there is a sort of now an increased premium increased benefit to developing renewables it comes with that additional security premium. So the return back to a low fossil fuel price environment, perhaps on the margin that impacts the competitiveness of renewables. But I think after the dust settles, if anything, it benefits renewables.
Thanks, James. Hanul.
Well, thank you for this question, and I think this is something that we try to really look into in the actual chapter when it comes to end use. I think what this crisis has proved, if anything, is that we're reaping the benefits of the investment that has happened in the past. So it's more so that not just this crisis has been a surge towards the need for more efficient uses of energy and electrification, but has also proved to us how past investments into using energy more efficiently in buildings, transport, industry has really reaped the benefits of allowing us for having more secure electricity systems, especially if you consider the supply shocks and external issues that we faced in the current crisis. If you consider making our energy systems more resilient beforehand, the case still stands that in the next shock or whatever happens next, you will have a more resilient energy system. So it is not something that that energy efficiency or end use sectors is not something that you can invest in overnight and these changes really take place. But it really takes planning and effort to make sure that the next time this happens, you have an energy system that is much more ready. So if anything, this crisis has really proved that the benefits exist and that now is the best time to invest so that when the next crisis or next shock happens, that systems will be ready and that it will show how efficient that investment was in the end.
Thank you. Courtney, do you want to jump in here as well about what this means for exploration?
Yeah, I mean, these are very interesting themes. And to your point, for oil and gas exploration and field development and adding reserves, that is a crucial component of oil and gas companies' financial performance and their financial situation. There is a lot of also inertia in the system, so it takes a long time to build up the portfolio and then to invest year on year to manage the production that comes. And so we see a lot of new projects and a lot of discussion about making sure that companies are going to really invest in rebuilding those portfolios. Exploration itself is not a particularly expensive. It's only about 50 billion of the total in a given year of the investment, and we have seen overall investment sort of humming along at around the same level for oil and gas, with gas coming up a little bit. But really, there's a lot of opportunities that companies and countries are undertaking to develop new resources off the coast of Namibia. Suriname and Guyana is a story, Brazil, so and then sort of up the coast of Africa. So you do see a lot of activity, and if anything, at least the signals now seem to be to invest more, although the absolute amount of that investment won't be super high just because that activity of exploration is not the most expensive thing.
Thanks very much. Rio, how do you see increasing cost of capital in emerging and developing economies affecting the pace of energy transition? And what mechanisms can realistically unlock capital at scale for these markets?
Thank you very much. It is a very good question. And yes, definitely so the cost of capital as one of the obstacles for the introducing and also the progressing the energy transition in emerging and developing market. So we think, and it is a reflection of the global situation, not only talking about the project list, but also in this world uncertainty also go to the some countries' risk or the finance situation. And we think that it is the object, and there are no single silver bullet to resolve this situation. But we think one of the cases is the collaboration of the government and also international funding, and also that countries' project like the blended finance to share the risk and take the risk what you can take, and also provide leverage the capital to that market. Also, we think some discussion about how to enhance the energy security in that country will support the driving the energy transition in some country, like using the solar PV for reducing the fossil fuel input. Will be maybe in case in some countries it will work to leverage the capital.
Thank you very much. So we have time for two final questions, one on end use and the final one on power. Hanul, what investment trends have you noticed for end use technologies in the first quarter of 2026, especially as those relate to electric vehicles and heat pumps?
Thanks for the question. And in the process of writing this report, we were actually going through the Q1 and now with the Q2. So we can only really provide this overview, hopefully in next year's VI. But we did try to look at individual countries or cases in which we saw a big interest for EV uptake or heat pumps. And an example for this is that in the member countries of the European Heat Pump Association, we see a very big growth in especially member countries that have huge subsidies. So we see a 17% in sales in Q1 compared to Q1 of 2025. Also, EV sales have grown, particularly in some certain regions, including Europe, Latin America, and also the Asia Pacific, in case you can also take a look at our report where we go into the detail about this. So we do see in certain regions where there is a lot of interest for end-use technologies, especially in Q1 2026.
Thank you. All right, final question for you, James. While gas turbine orders have grown due to data centers, the actual supply is constrained on the manufacturing end. So how do you see the long-term growth of gas investments in the US? Will many projects just not materialize?
Interesting question. I wish I had a crystal ball. There's a lot of interest and questions about US data centers and gas demand. Look, I think for sure, gas turbine manufacturing is a major constraint. We've heard time and time again that the major OEMs like Siemens and GE Vernova, they're filling up their order books to 2028, 2029, 2030. So it will take quite some time for these projects to ultimately get a grid connection or actually start generating electricity. That being said, they all have plans, or at least the major manufacturers have plans to scale up their production significantly over the coming years. I think that's a clear signal of where the market is heading. It's difficult to say 4 or 5 years from now what the market will look like, but at least in our report, the projects that we're tracking, we're not tracking these speculative announcements. We're talking about firm orders. So the investment and gigawatt capacities of orders that we have in our report, those are projects that are very, very likely to materialize. But I would also just mention one last constraint, and that is public backlash, local concerns, environmental concerns, all sorts of concerns about the development of data centers. So I see that as being really a major constraint moving forward, particularly around 2030 and moving forward.
Thank you very much. Well, with that, we're at time. I'd like to thank all of our participants for joining us today for this webinar and for all of your excellent questions. I'd like to thank my colleagues around the table here for sharing the key messages from the reports with us and for answering the questions. And I'd also like to thank my colleagues Ryan Chang and Sam Tarling for their support behind the scenes to ensure we had an excellent webinar. And finally, to mention that next week, we will host a second webinar with some of the other authors of the report, which will focus in on some of the regional findings from the World Energy Investment Report. Thank you very much.